let's talk about the answers to the discounted cash flow exercise. And I really want you to play around with the numbers here, okay? I want you to change numbers on all of these tabs here, change the assumptions here as well, here, everywhere. And I really want you to understand how all these tabs work together and how all these different metrics can change a target price, okay? Please learn to read financial statements like a good book. And I know it sounds a little crazy, but I just want you to understand this and not memorize. Never memorize accounting or finance, please. Just understand it and then you'll remember. Okay, cool. Let's kick it off with this box here. We hit Shift, select, delete. Cool. And free cash flow is always just pulled off the cash flow statement, right? It's a simple calculation. So let's hit Command and open square brackets, and then boom, you're linked. There we are here, okay? And then basically just double click and it's operating cash flow minus CapEx. That's what free cash flow is, right? It's a simple calculation down here, but I don't want you to just memorize this. I want you to really understand what it means, okay? So let's look at it this way. So let's say that you are a company, okay? And you make a bunch of money, you put the money in your pocket at the end of the year, and then you want to invest in yourself, right? So you'll invest. And so what cash do you have left over now? Well, it's whatever money I made during the year minus the money I used to, what was left over to invest in myself. And from a company perspective, all it is this: operating cash flow minus the amount of money that we invested or reinvested in the company, okay? And that's basically equipment, CapEx, right? So operating cash flow minus CapEx is free cash flow. And you might ask, well, Chris, I don't understand. Why don't you just use net income minus what we invested? Well, recall from our earlier exercises that net income is not really cash you have in your pocket, right? When you create a cash flow statement, you basically start with net income, and you add back all the non-cash stuff from your other financial statements, like depreciation, which isn't money out of your pocket, right? Anyway, that's how we get free cash flow. And again, play around with the numbers, see what happens. Let's try it actually. For fun, let's just say I went to the revenue tab, and for whatever reason, I'm going to delete all these lines here. Massive product recall, right? Let's see what happens. It flows through here. Earnings get hit hard, right? Cash flow statement obviously gets hit as well. And let's see what happens. Free cash flow. Okay. So free cash flow is now 1331 for that year. Let me Control Z to undo what we just did. All right, I just undid it. Let's go back and see how it's higher, 1466. So play around with the numbers, right? And we can even do that again, right? Let me go back here and get rid of that, right? And what happens is our target price down here, right, becomes 20 bucks, right? But if I undo it and go back, right, our target price is 22 bucks, right? And you might say, well, wait a second, I don't understand that. You deleted all the revenue or part of revenue and target price only went down $2. Well, it did because this revenue line here is pretty small as a percentage of revenue, right? It's only 5% of revenue, right? This guy here, this line is 95% of revenue. Anyway, you get the idea. I want you to play around with this a lot, okay? And you can even use this as a template for yourself when you create your own models, right? And remember, every model is different because every model has different number of revenue line items, and the way to calculate revenue is always different. Anyway, you get the idea. Just play around with this model a lot, please. Okay. So let's calculate what the interest rate is we're going to use, or discount rate, or WACC, same thing, to take all these future cash flows into today's terms. Remember that we don't get the benefit of having that much cash today because of interest rates. We have to discount it a bunch of years to today, okay? And the same with this one, this one, this one. Let's calculate the WACC. Remember to hit the Shift button and hold it down the whole time, then hit delete. Otherwise, it's tricky to get those things off. Okay, so the cost of capital for us is going to be a function of, well, how much equity do we have? How much debt do we have, right? And then we'll get the percent of debt that we have in our capital structure times the cost of debt, plus the percent of equity we have in our capital structure, times the cost of equity, and that's our blended weighted average cost of capital. Okay, cool. So the market cap today is 10,000. Just accept that. That's a given, okay? The stock price today is $8.58. It's just the market cap divided by the number of shares. And you might say, well, wait a second, what if I change the number of shares? Let's say we had a lot of cash in our balance sheet and we're like, heck, what do we do with that cash? Let's buy back some shares. What happens to the stock price today? So watch that, 858. Let's see what happens. Okay, I'm gonna go down here and I don't know, let's just say I changed this to 1,000 shares, okay? And let's be crazy and do it everywhere. Say we bought 1,000, we bought back 1,000, we bought back 165 shares, okay? Let's see what happens to our price. Is it still 865 or whatever it was? Let's see here. No, it's 10 bucks. Isn't that cool? So if you buy back shares, say a company has excess cash, right, on the balance sheet, what do we do with it? Well, I don't know. We don't invest in any more property, plant, and equipment. We already have all the stuff we need. Well, heck, we all own shares in the company, and our investors will love us if we buy back shares, right? Let's do it again. Let's say that we have a crazy amount of cash, and we buy back a ton of shares, and now we're actually at 500 shares. Wow, we bought back just a ton. Let's go here. Wow, look at that, right? We cut the number of shares in half from 1,000 to 500, and of course the stock price doubles, okay? Undo, undo, undo. Again, there we go. Okay, one more time. There we go. We're back to normal now. Okay, so back to 858. And that's what I mean, just really play around with this model a lot, please, because again, I really want you to understand how all this stuff works together. So most of our capital structure is equity. Only a little bit is debt, right? And you're like, well, Chris, how do you calculate that? Well, the capital structure is a function of equity plus debt, right? And so if we go here to our balance sheet, right? Remember, this is just a measure of what we have and who owns our stuff. And we just take a look here. Let me zoom in a bit, make it easier to read for all of us. Okay, so let's just pick a quarter here. So we have $5 in short-term debt and $5 in long-term debt, right? That's how much debt we have, right? But remember, capital structure, right, is a function of debt plus equity or liabilities plus equity, same thing. So 5 plus 5 is our debt and our equity is that. Okay, wow, look at that. We have way more equity than we have debt. Actually, we have close to 98% of our entire capital structure is equity, right? And about 2% or 1.7% to be exact is debt, right? That's just 5 plus 5 divided by that plus 10. Okay, so let's look at the math here. All right, so the capital structure, okay? Let's figure that out. Ignore this guy for now. And this formula you see here is just equity, which we talked about in the previous page, which was over 500 bucks, divided by short-term debt, long-term debt plus equity. And by the same token here, ignore this guy for now, right? We're focused on the percent. You go to the balance sheet, what percent of your capital structure is debt? And it's short-term debt plus long-term debt divided by short-term debt plus long-term debt plus equity, right? Which is about 2%. Whoops, okay. And again, play around with all these numbers, right? Play around with everything. Okay, so we know the percent. So the percent that's equity is about 98%, and the percent that's debt is about 2%. Okay, so we understand the percents as the capital structure. Okay, don't memorize this stuff. Please understand it. Remember, learn to read financial statements like a good book. All right, so we take C41, right? That's our cost of equity, right? And then our cost of debt's from below as well. So let's start with equity, right? What is that cost of equity there, right? C41. Well, how do we calculate the cost of equity? Okay. So what happens is the cost of equity to us is simply a function of this. What's the lowest interest rate on the planet, basically, right? Well, it's the government interest rate because the government is less likely to go belly up than my company here, okay. All right, so if I have to calculate my cost of equity, I'll start with the government rate, which we call the risk-free rate because it's almost risk-free, because if the government goes belly up, then we're all done. It's the last company to go belly up. And then we add back the additional stuff that's going to account for how much more risk there is to investing in us versus the government, right? Or the lowest risk-free rate. So how do we calculate that? Well, all right, so our company's on the stock market, right? And I guess that all companies in general, if you just ignore beta for now, all companies in general, you take the stock market return minus that risk-free rate, and I guess that's what the general return would be, I guess, right? All right, hold on. Well, I don't understand this. Well, our beta, we're more volatile than the government is, right? So we should put in more risk for owning our stock. Okay, I get it. So beta is basically this, and we talked about this earlier. The beta of the stock market is basically 1, okay? It looks, it's a nice, healthy looking chart, whatever. It's not that volatile. It's 1, okay? And beta just means the rise over the run or volatility. And let's not get involved with the calculus. And so the beta of our company, because our company is riskier than the stock market index, it's riskier than the S&P 500, for example, or the FTSE or the DAX or whatever, or the TOPIX, whatever index it is you cover, okay? All right, so our beta is 2, which means that our stock is 100% more volatile than the market, right? And you can go to Yahoo Finance and get betas for different companies too, right? Okay, cool. So our beta is 2. Great. And we're assuming the average stock market return is 8.5% over time. Just accept that. Don't worry about the logic there. And then assume the risk-free rate or the lowest rate out there is about 2.5%, which is government interest rate plus inflation. Just accept it. I've seen people use 1, I've seen people use 3, whatever. And interest rates will never be this low again for the rest of our lives. So many years from now, when you're doing this exercise, or creating your own models, the risk-free rate will be a lot higher. Okay. And by having interest rates really low, what the government's basically saying is, please invest in stuff, invest in the stock market, buy real estate. And that way the stock market goes up a bunch because rates are low. When rates are high, people say, I'm not going to invest in the stock market. I'm going to buy, debt. I'm going to buy bonds. Okay. Anyway, so let's get rid of this. Oops. It's tricky. Hold down shift and then hit delete. I always forget that. All right, cool. So all we're doing here is the cost of equity is just the risk-free rate, right? Pulled from there, plus the beta, which is 2, right? Times whatever the stock market return is going to be minus the risk-free rate, okay? And that is 14.5. That's a high rate because we're a risky company. Check this out. Let's say that we were lower risk, right? A lower risk company. So instead of being a Tesla, for example, which is a great growth stock, we're now, I don't know, General Electric or Verizon. We're, a higher interest or higher dividend yield company. That's lower risk. If we pretend our beta is 1, watch what happens to the rate. Look at that. Our rate goes from 14.5% down to 8.5%, right? Risk has a lot to do with the rate you're supposed to pay, right, for equity. So watch this. If our target price, just accept this for now, I'll get here in a second, is $22, right? Watch what happens if I make our beta 1. Okay? If the risk is lower to invest in our company, watch what happens. Our target price goes up enormously. It's a big deal. It's a big deal. Okay. And let's play around with it again. Let's say that we were half as volatile as the market, which almost never happens. But let's just say that you're ridiculously low risk company, right? Beta of 1, $90 target price. Unbelievable. And then try here. And you'll never see betas as high. Let's say a beta is 4 though, right? You've never seen that high. Look at that. That means our stock is basically fully valued right now. Okay. Okay. Anyway, let's just stick with this. 14.5% is the cost of equity, right? Now, but Chris, why is it lower here? Because 98% of our capital structure roughly is equity. So you take that times the percent, okay, of our capital structure, that's equity, and you get that one. Okay, cool. We're going to talk about debt in a second. So just remember, ignore this guy for now. Take the percent of the capital structure that's debt times whatever rate you come up with, okay? And we have a tiny, tiny percent of our capital structure that's debt, right? So let's go here. What is the cost of debt? Okay, I'm going to get rid of this one. Okay. All right, so the cost of debt is basically a function of whatever the bank is going to charge you to get a loan, okay, times 1 minus the tax rate, okay? And for simplicity, let's just assume the tax rate's 33%, right? Okay, cool. So what happens is our cost of debt's really not 5%, it's 3.4% because the government says, hey, let me give you a tax incentive, right? Whatever interest you pay on debt, you can deduct, right? It's just math. So let's say, well, we're a higher risk company. No one's going to give us debt at 5%, right? Let's say that we get like a junk bond rate. And junk bond basically means a high rate. right, for a debt instrument, right? We're a high risk company. Let's say it's 20%. And dude, I remember in the early 80s when my dad was paying a 20% mortgage on his house in Canada. Rates were high then. Look at that. So our cost of debt goes up a lot, obviously, because look at that. Our debt now is 20%. That's just given us whatever the bank's going to lend you at, right? You're like, well, why isn't it 20% here? Well, because of the tax rate. So what if we took the tax rate and we made it, say we're in an awful recession, the government decides, let's cut rates to 10%, which would never happen. Watch what happens. Look at that. Our cost of debt goes to 18%. You're like, I don't understand. Why would it go up if rates are lower, right? Well, what happens is if tax rates are lower, then you can't deduct as much. I know it's a weird, complex relationship, but anyway. So let's go back here to 5, right? So 3.4% is what it's going to cost us for debt. Cool. So let's go here. And you're like, well, Chris, I thought it was 3.4% down here. What happened? Well, it's 3.4% times the percent of our capital structure, which is debt. And remember, we only have like $5 of short-term debt and $5 long-term debt, which is 10 divided by the total capital structure. So we got like 1.7 or about 2% or so of our capital structure in debt. So you take 2% or 1.7, whatever it is, times that, and actually the cost here blended with our capital structure is only, 0.0573%. It's not 3.4. Okay. All right, good. So now we've got the blended cost of capital for us, our interest rate for our company, or discount rate, or WACC, same thing, weighted average cost of capital, right? Because the capital we have is weighted. Double click it, and we've got 14.31 is our cost of capital. Okay, good. So we understand how we got our interest rate. And the reason we calculated this interest rate is because you can't just add up all these cash flows. It's not fair that we get that amount today factored into our valuation, right? We got to discount that over a number of years, right? So what do we discount it at? Well, we just calculate the WACC, right? The discount rate. All right, let's go through this. All right, cool. Now, the way to discount all of these cash flows, right? You don't have to discount this once basically today, is to use net present value or discounted cash flow analysis. And I'm going to do cool. So we've got our weighted average cost of capital. It's 14.3. So let's figure out what these guys here are valued today, right? Because again, you can't get that money today, right? It's not fair. You can't say, well, I'm going to make that money, so I should have it today, and that's my valuation. Well, it's not fair because of interest rates. You have to deduct it over time, right? So basically, you have the present value, I should say, right? So let's do that. Okay. So let's click here. I always forget to hit shift. Shift, click, take my finger off, shift, deletes. Got it. Okay, good. So what is the net present value of all those cash flows today? Well, watch this. If I just add up all these cash flows here, right, just mouse over, the value is 9,181, right? That's the value. And so you can't take the value because we got a WACC, an interest rate we have to deduct them at. All right, so let's do that. So watch this. If I were to, this is just net present value, which is the rate and then all the cash flows. I love Excel. Basically, if you don't understand any of this stuff, just click here and Excel will kind of explain it to you. And if this is kind of, I don't know, boring to read, whatever, just go to YouTube and do a search on NPV Excel, okay? All right, so Excel is awesome because you type in the formula and all the stuff drops down. So watch this. We'll do it from scratch. I'm going to delete it. Equals NPV. It's in the game. Okay, open brackets. And then it tells you get the rate. You're like, what's the rate? You can click there. It's supposed to tell you what it is, or a definition. What you do is you go up here and you're like, okay, my rate was this, right? And then it's telling you put a comma. See the right there? You're like, okay, I'll put a comma. And it's saying, okay, go get the values of those cash flows. Okay. You go here and you highlight them all. Boom, you're done. So those free cash flow numbers are worth that much today using the rates. You double click it and Excel's awesome. See, it's color coded. Very cool.